Welcome to The Explainer. Today, we're going to talk about something fascinating, how one single accounting rule, IFRS 16, basically made billions of dollars in corporate debt that was totally invisible, suddenly pop up on the books for everyone to see. So here's a question for you. What if a company's biggest debts were completely invisible? I know, it sounds like a trick question, right? But for decades, it was the reality. We're talking about some of the largest financial commitments a company could have, just hidden in plain sight. They were disguised as simple rental agreements for, everything from the corporate headquarters to entire fleets of airplanes. Okay, so let's get into it. To really understand why this new rule was such a game changer, we first have to go back and look at the problem it was designed to solve in the first place. All right, so under the old rules, that was a standard called IS-17. There was this one tiny distinction that created a massive loophole. It was called the operating lease. Now, to get this, just imagine two airlines. Airline A goes out and buys its entire fleet. So its balance sheet, it's loaded with massive assets and, of course, massive debt. But then you have Airline B. It leases its whole fleet. Well, under the old rules, those huge multi-billion-dollar long-term promises to pay for those planes, they often didn't show up on the balance sheet at all, not a single line item. They were just treated like a monthly bill, completely hiding the real size of the company's financial commitments. You can see the problem, right? This whole off-balance sheet thing made it incredibly hard for investors to actually compare companies, or even just to get a real sense of their financial risk. So eventually, the International Accounting Standards Board had to step in, and they came up with a new, much stricter rule. And the mission behind this new rule, IFRS 16, was really clear and direct. It was all about one thing: transparency. The whole point was to make companies show a more complete and honest picture of what was really going on, giving everyone, investors, analysts, you name it, a much better way to figure out a company's true financial health. And, looking at this timeline, you can see this wasn't some snap decision. The original standard that allowed all this goes way back to 1997. It took almost 20 years of debating and work before IFRS 16 was finally issued in 2016. And then it didn't even become mandatory for most companies until 2019. So yeah, a long time coming. So what was the huge change that IFRS 16 actually brought to the table? Well, in a nutshell, it forced companies to add two totally new things to their balance sheets for pretty much every single lease they had. First up, the company that's leasing the item, we call them the lessee, now has to record something called a right-of-use asset. And that's exactly what it sounds like. It represents the value of their right to actually use that building or that vehicle or that big piece of equipment for the entire length of the lease. Okay, and to make the accounting work, to balance that new asset out, they also have to recognize a lease liability. Now, this is the really crucial part. This is a formal debt that goes right onto the books. It represents the company's promise to make all those future lease payments, all crunched down to what they're worth in today's money. And this slide just lays it out so perfectly. You can really see the transformation here. Something that used to be buried deep in the footnotes of a financial report is now right there, front and center on the balance sheet. That invisible promise to pay, it's now a visible asset, and, way more importantly, a very visible debt. But hang on, that only covers one side of the deal, right? What about the company that actually owns the asset and is leasing it out? The lessor. Well, kind of surprisingly, for the lessors, the world didn't change all that much. The real revolution of IFRS 16 was squarely on the lessees side of things. For the folks who own the assets, the accounting rules pretty much stayed the same. They still have to classify their leases like they used to. So lessors still need to figure out if a lease is a finance lease or an operating lease. And they do that by basically running through a checklist of questions. They're trying to see if the lease, for all intents and purposes, transfers all the risks and rewards of owning the thing to the person leasing it. If the answer to these kinds of questions is yes, then it gets treated more like a sale. If it's a no, then it's just treated like a regular old rental. Okay, so at this point you might be thinking, wow, that sounds like a ton of work for every single little thing a company rents. And you know what? You'd be absolutely right. Which is exactly why the people who wrote the standard built in a couple of common sense shortcuts. Basically, companies get a pass on certain leases. They don't have to go through this whole song and dance of creating an asset and a liability for really short-term rentals. We're talking 12 months or less. And they also don't have to do it for leases of low-value stuff, things like laptops, phones, or maybe a few office chairs. All right, let's zoom out and put this all together. What is the actual real-world impact of moving literally trillions of dollars of these lease commitments onto corporate balance sheets all over the world? Well, for starters, by putting all those right-of-use assets on the books, a company's total asset value goes up. Just like that. On paper, the company instantly looks bigger. But here's the flip side. Their total liabilities also shoot up by the exact same amount. And that means some really important financial health numbers, especially anything related to debt, can change dramatically almost overnight. And here's a trickier, more subtle effect. There's a super popular performance metric called EBITDA that stands for earnings before interest, taxes, depreciation, and amortization. And it actually goes up. Why? Well, it's because that old rent payment, which used to be subtracted out, is now replaced by interest and depreciation costs, and both of those things are excluded from the EBITDA calculation. It's a bit of a technicality for sure, but it's a really important one for analysts to understand. And all of this really just brings us to the ultimate outcome. IFRS 16 totally levels the playing field. Remember our two airlines from the beginning? Now, for the first time, you can actually compare Airline A, the one that buys its planes, with Airline B, the one that leases them, on a true apples-to-apples basis. It gives you a much clearer picture of their debt, their leverage, and most importantly, it delivers on that promise of a faithful representation of a company's commitments. And that, of course, was the whole goal from the very beginning. So in the end, the standard didn't magically create any new debt out of thin air. All it did was drag existing promises out of the shadows and put them right into the spotlight for everyone to see. And it leaves all of us, whether you're an investor, a manager, or an employee, with a much clearer, more transparent financial world. And it leaves us with a new challenge, rethinking what a truly strong balance sheet actually looks like. And that's it for this explainer. Thanks so much for watching.